Hello and welcome to the Property Trio, the podcast for the sophisticated property buyer. Not as always, I'm only joined by Cate because
Yeah,
Mike's riding his bike for charity around Thailand. So good luck to Mike. Hope he's doing well. And how are
yeah.
you, Cate?
I'm good. It's different without Mike, but it's kind of special as well. This is, where it all started. You and me
Yeah,
masterminding this. So
sure
yeah,
did.
we'll miss Mike, but we've got some good data to go through today together, and it'll be
Yeah.
interesting to see how we, go back and forth with our opinions and manage to host it.
Yeah, we've only done a few with the two of us, I think, where
Yeah.
Mike or Pete have been away over the journey. So,
Yeah.
yeah, so today is the February market update, and there's been some interesting data come out for the month of February, Cate. A bit of a changing of the guard that we've been talking about could happen. It looks like it may be about to start to happen, but 1 month certainly isn't a trend. But tell us about what's happened on the indexes in February.
Yeah, 1 month isn't a trend, but gee, we've felt something brewing in Melbourne, haven't we? The two of us
Yeah.
have, had a definite uptick in work and inquiry and sentiment is what's driving it.
Mm.
And the core logic data is interesting. I saw it first published in PropTrack, that Melbourne did 0.67 for the month of February. So they've rounded it to zero point 0.7 in the media.
Yeah.
CoreLogic's reporting something slightly different, but it comes down to, how they cut the data as well. And we're looking at home value index results. And I'm possibly it was a house figure. I'm not sure.
So PropTrack is realestate.com.au's index. So it's
Yes.
different entities. So they have their different methodologies behind the scenes. So they come out with different numbers. And although CoreLogic's methodology is much more sophisticated, I think sometimes that sophistication can mean that it isn't as quick to pick up changes
Mm.
because it is so detailed in terms of how the numbers come out. So I think sometimes the simpler indexes can pick up change faster. And I think that's why that one had Melbourne at 0.67%, whereas
Mm.
Core Logic only had Melbourne at 0.4%. But still both had Melbourne as the leading capital city. Core Logic also had Hobart coming in at 0.4%. Um, but Melbourne was a clear leader in the prop track index, with second for the month of February had Sydney at 0.5%.
Yeah.
Yeah. And then Adelaide was at 0.33 and this is on the prop track home price index. Brisbane 0.29 and Perth really flat now, down at 0.02%. So we really are seeing those mid-sized cities that have been on such a tear for the last couple of years, seemingly starting to run out of juice to some.
Yeah.
Mm. What are your
It's
thoughts?
That's certainly what the data suggests. And I know
Mm.
Feb's a funny month.
Mm.
January is an unreliable month. So we
Yeah,
chatted about that last time. But Feb, I often find in Melbourne, you've got a lot of pent-up energy because we're such an auction culture. The the property market really does go into hibernation over Christmas time and Jan. And
yeah,
agents don't mind taking all of their holidays in Jan and coming back after Australia Day, which means we've got a lot of buyers floating around saying, "Hey, where are all your listings?" And they're
yeah,
they're chomping at the bit to get back into it. So you often find that there's a fair amount of steam in February anyway, and that's
yeah,
probably the one thing that's stopping me from saying, "Yeah, it's definite. We're having a run,"
yeah,
because Feb is that kind of month. But I'm sitting here now, in mid-March, and we've got a lot of activity and we've got a lot of listings, but people are still buying and, investor and owner occupier participation is strong. Auction participation is much stronger than we've had in past years. So
yeah,
I think there is steam there, but with just February to look at, some will argue. I heard someone say yesterday, "Oh, do you think it's a dead cat bounce?" I don't think it is, but it's not stock levels that's having us experience this because we've actually got quite a bit of stock. So it's
yeah,
definitely on the demand side of the equation, not the supply side.
yeah, yeah. So look, we've certainly we've had an episode, we've written some blogs on some of the data that suggested Melbourne was right for the picking. And that's come through with the numbers potentially in February. But yeah, as you've just said, February, there can be quite a bit of pent-up demand, and it is a shorter month as well. So we'd certainly like to see the data come through, for another month or two to be confident that that is going to play out that way.
Yeah.
Is there anything else that you noticed for the month of February?
Yeah, I did. Look, Sydney's such a big market, and for Sydney to have that performance, whether it's point 0.3 or point 0.5, that's a lot of housing stock. And I noted that the combined capitals are still being trumped by the combined regions. So regions are still going strong.
Yeah, yeah. So regions are still continuing to outperform the capital cities, aren't they? But
Mm,
if Melbourne and Sydney can start to rebound, we know they cover about half the population, and so they have an outsized effect on the broader capital cities
yeah.
movements. So that could begin to change, but the only time will tell in that area.
Mm,
Um, so something else to note is we know the upper quartile had the largest falls during the downturn in particularly Hobart, ACT, and Melbourne. So
yeah.
what happened was Hobart has fallen by 11.9% from its peak, ACT 7.1, and Melbourne
Yeah.
6.4, but the actual downturns in the upper quartile were larger than that. So
Mm,
Hobart down 16.4%, ACT's upper quartile was down 9.8, and Melbourne's most expensive quarter dropped by 8.9. And CoreLogic reported that the growth in the month of February for Sydney and Melbourne was driven by the most expensive quartile,
I'm
and
not
yeah,
surprised.
the upper quartile. Mm.
Yeah, and you and I have often spoken about this when you have economic recovery or when you have an upturn and credit is available, you often see the upper quartile really getting fueled. And that's
Mm.
what's been happening. I've been quite surprised with when I segment the price points that I've been working with for investors and owner occupiers. Over a $2 million budget's not unheard of for me, but it's not my common ground. I'm based in the inner west, and if I was inner east, it would be a bit different. But to have a budget that's above that, I take note when I'm at auction, and I'm really careful about watching how trends are changing. And I had an auction in Clifton Hill a couple of weekends ago, and the difference for me between 2024 and 2025 when it comes to auctions is in 2024, if I quiz the agent about who they expect to turn up, most of them are pretty straight up with me. They'll go through their list of buyers and say, oh, we think there's 3 of you or 4 of you. And in 2024, you could subtract the number 2 from the agent's estimate, and that would give you a pretty reliable number of bidding, um, auction
Right.
participants.
Yeah.
And in
They
2025, you add
over-egg it
2.
by two people.
Yeah, they would.
Yeah.
And it's because,
This
people
year, yeah.
they'd get cold feet or they'd find something else, or, they
Yeah.
couldn't get their hands on the money or the broker was late, whatever. I
Mm.
could anticipate that the agent's estimate was -2. This year, it's +2. It's so
Yeah.
weird
Okay.
seeing an agent, an auctioneer
Mm.
standing out the front of a house scratching their head saying, well, where did this guy come from? I've never seen him before. Or these guys are here. They look like they're going to bid. They've given me nothing. I thought they weren't interested. People are behaving a little bit differently to 2024, and the agent estimates are still off track, but in the other direction now.
Yeah, and it's those sort of insights that you get attending auctions, I think, that give us a real understanding of what's happening potentially before it does flow through with the
Yeah.
numbers. And there's certainly been research done that suggests the upper quartile feels the pinch most by interest rates changing. So
Yes.
obviously we've had a really sharp rise in interest rates, and the upper quartile has felt that in particularly those three cities we just mentioned. But now with one rate reduction, with the expectation of another 2 to 3 over the next 12 months, we're seeing the early stages for 1 month only, I'll
Mm.
stress, but in Sydney and Melbourne, where the upper quartiles perform the strongest. So we'll keep an eye out for that trend.
Yeah. The question
Yeah.
really is it sentiment and that wishful thinking around continued interest rate cuts that's driving that end of
Mm.
town? Or is it actually the 25 basis points that made a marked difference to their borrowing capacity? I wouldn't have thought that the latter was all that likely.
Yeah, which I think, that is sentiment,
Mm.
but it's also, I guess, people are going, okay, well, it's come down by 25 basis points. So sentiment will change. Let's get ahead of the game. Let's get in there. We think we're potentially at the bottom of the market. We're seeing properties sell for prices. This is particularly, say, in Melbourne, but
Mm.
some of those other capital cities where they were selling 2 years ago, and they're still, they went up and then they came back down. So I
Yes.
think people are saying, okay, this is could be the best opportunity to buy, and we expect our rates and therefore our repayments to fall by another 50 to 75 basis points.
Yeah.
Now's the time to get in, and some of that will play out when we get to the consumer sentiment index as well,
Yes. Yeah. Very
which we'll
much
come
so.
to.
Yeah.
Is yeah, anything else before we get into rents on
No.
no on the monthly movements? So what do you notice in rents?
Wow. Well, for houses, um, aside from Perth, Adelaide, Hobart at 6.4, 5.1, and 4.5 over the rolling year, everything else is within or below the target band for inflation. So now we've got Canberra and Darwin sitting at 1.9% and 1.4% respectively. That's under inflation. So you could argue now that their rents are softer than the standard rate of inflation. If we have a look over at units, again, everything has come right down. Adelaide and Perth and Darwin are still the stronger ones, but all of these trajectories, other than Hobart's for units, which is a bit random because it's not the same for houses, everything else has moderated. Nothing's looking like it's really upticking. So rents have definitely settled down. We've had a perfect correlation between the direction of our rental growth and the amount of airtime that our politicians get to talk about rental crisis.
100%, it really has gone off the charts in terms of
Yeah,
the politicians talking about it in the media, or the media just talking about it generally, hasn't it?
yeah.
Because we have had this normalization of rents, particularly in that back end of 2024.
Mm.
And I got a bit of data from the CoreLogic specific. So the rents rose again by 0.6% in February. Now that is the strongest gain since May 24, but that is quite seasonal, as we've spoken
Yes,
about. So we take that with a grain of salt. Um, so nationally, in terms of just an average across the country, and you've spoken about some of the capital cities themselves, but as you alluded to, rents have risen. It's 4.1%, so it's a little bit above inflation, but not much over the last 12 months, and it
yeah,
has been slowing down, but there's not many capital cities that have risen. Their rental growth has been greater than that 4.1%. A Perth at 6.4% for houses has pushed that up, and Adelaide at 9% for units has pushed that up. And Perth at 8.4% for units has pushed that up. But nationally, it's been 4.1% over the
mm,
last 12 months. Something we've always also spoken about, and Pete did that, the analysis on it, that the pre-pandemic decade average was just 2%.
yeah.
So there's still an argument that rents are still playing a bit of catch up after being really weak
They were
for
stagnant for ages.
for an entire decade, weren't they? And potentially
Yes.
longer. Um,
And I find
so
it
yeah,
intriguing that you see some, sometimes I get a journalist asking me, or you'll read a claim that landlords are pushing up rents because of the cost of holding their property. And rents don't work like that.
No.
It really is a
Yeah.
supply and demand driven
Mm.
phenomenon, and you can't just put your rent up and expect to get it because someone else with a similar property that's going for cheaper will get the tenant.
Yeah.
So, this is a perfect illustration of supply and demand at work. And I think we've talked about household formation rates and the correlation between that and rental demand. And I think we've seen a lot of that at play too. Households have settled down since COVID.
Yeah, yeah, we know that. So the household formation rates, the number of people on average living in a house, has increased, and that makes a
Yeah,
material difference to the number of properties that are required for people to live in across the country. It becomes less by a significant margin, just
yeah,
by household formation rates changing by 0.2, 0.3% higher means you've got tens of thousands of properties that are no longer required for people to live
mm,
in. And we've also had that normalisation of overseas migration as well, haven't
yeah,
we?
yeah, very much
Yeah.
so.
And look, some of these changes, particularly with the normalization of overseas migration, has played out in the unit markets. So Sydney's unit rental growth has dropped down to 2.7% um, versus its peak of 17.9% in
Yeah,
April,
that's
May.
enormous, isn't it?
It's huge of
Yeah,
2023. Melbourne has dropped from 15.2% to 3.2,
yeah,
and Brisbane 15.3 to 3.3. So that's part of the overseas migration story. It's part of the people moving back into with families or larger numbers of younger people potentially renting and living
yes.
together. So yeah, we're starting to
Look at
see,
the,
yeah,
I marvel at Darwin. That to me screams COVID escapades.
yeah,
I know people
yeah.
that went to Darwin during lockdown.
I think I did see a number that about Darwin going through the roof, actually. Here we go. The most significant slowdown in annual rental growth has occurred in Darwin,
Yeah,
where rents were booming through the pandemic when house rents reached a peak annual rate of growth of 25%.
yeah.
And that has slowed to 1.4% over 12 months. So yeah, good, well spotted.
It's amazing,
That's
isn't it?
yeah, it's probably the best example of the changes. Now, if we move on to rental yields, is there anything that jumps up for you in terms of the rental yields?
Not so much. Rental yield is a bit of a stable kind of indicator, isn't it? It takes
Yeah,
a lot of water and wind to move that ship.
yeah,
And we've still got the core logic figures have Adelaide, Brisbane, and Melbourne all running together at 3.7. I'll
mm,
be interested in tracking that. We all are,
yeah,
because I've always thought that Melbourne's yields will continue to increase while we've got a rental shortage, and and once we've got more pressure on our rents. Although it could be argued that that might start to ease. I've certainly noted that I've had more investors coming to me, and that's my only real litmus test,
mm,
if I'm honest about it, because I haven't got the raw data in front of me in real time, but I can see what
yeah,
blend of my clients are owner ox versus investors, and we're getting a lot of interstate investors. So that
yeah,
might slow down the headwinds for Melbourne's increasing rent, but I'd like to keep an eye on it because I think that's a bit of a legislation
mm.
change story.
Yeah, well, I guess the challenge, if the Melbourne property market does pick up again, will be for rents to keep up pace with capital growth. And we might be coming into a phase where the capital growth may outstrip the rental growth, even if there is solid rental growth, which
Mm.
ultimately will push down the yield.
Yeah.
But we know that, yeah, as we've talked about, Melbourne's yields actually getting surpassing Adelaide and Brisbane's
Mm.
um, on average was the first time on record that had happened. And that's certainly something that interstate investors and buyers agents would take note of.
Mm.
And, we know those interstate investors can certainly play a part in moving markets.
Yeah, they can indeed, especially the big ones.
Yeah. Vacancy rates. What are we seeing with vacancy rates?
So we've had a slight increase on our vacancy rates. And we've got, depending on which cities you're looking at. So this time last year, Sydney was at 1.1 and now they're at 1.5. Melbourne was at 1, now we're at 1.8. I mean, that's obvious. Last year we were still getting really, really heady rental increases. So
Mm.
pretty much every single um, capital city except Darwin um, has increased their vacancy rate slightly, and
Yeah,
Hobart. So both Darwin and Hobart have got a little bit tighter. They're funny markets though. When we looked at our capital
yeah.
growth back at the start, Darwin was the only one that delivered a negative growth rate for Feb, but then for the
Mm.
quarter it was actually okay. So it's showing
But
a
then
little
for
bit of
it's still behind where it was 10 years ago as well.
yeah, yeah. It's
Yeah.
volatile is the wrong word, but it's very glitchy.
Mm.
And
Yeah, it's
Hobart's
glitchy
been doing
month to
that.
month, and
Yes.
it's probably fair to say volatile over the longer term.
Yes. And I think, they're two markets that are much smaller in number. And
Yeah.
so it's very difficult to get a clear read on a
Mm.
market when you don't have a lot of sales each month, not like the
Yeah.
big cities.
Yeah, exactly. So look, I mean, overall, probably the overarching picture is vacancy rates are still really low, historically low, but they are
Mm.
starting to ease somewhat across the board.
Yeah.
But they're still very, very low. So if we move on to listings and the SQM data that came out on the 4th of March, what
Yeah.
have you noticed with some of the listing numbers around the country? Maybe we'll start with total property listings.
Yeah, total is probably the measure to look at as
Yeah.
opposed to new listings, because new listings, if we're looking at the monthly change, they're all in like super double digits because January is a nothing month for a lot of cities.
Mm.
But yeah, for total property listings, Sydney's got 10.5% more this time this year than the same time last year, which is a big figure. And their monthly change is 11.6. Now, what I love about this is Sydney still wrote some gains. So even though they've got more than 10% additional listings, obviously the demand is there because they've experienced growth in spite of this, which is not what I would have imagined. Melbourne's half that rate, really, 5.5% monthly change, but 4.8% yearly change. So, with 5% extra stock, and we're just starting to show potential signs of a market turnaround. That's encouraging. Brisbane is 1.5% up on the month and 1% up on the year. Perth is down. Now, this surprised me, Dave, because Perth didn't record strong gains for Feb,
Mm.
yet their stock has tightened annually and monthly. I was surprised by that.
I think
Um,
I think it's a pretty interesting point, actually, if we just hover on that for a second or two, that Perth people aren't necessarily taking gains and selling just yet, even though it
mm,
does seem like it's pretty likely we're at around the peak
yeah.
for Perth, and that sort of plays out even if we look over the last quarter in terms of changes in dwelling values. Perth was 0.3 for the month, but it's only been 0.3 for the quarter. It was
Mm,
flat for the previous 2 months, so it really has slowed down, at least in the last quarter, much faster than
yeah.
Brisbane and Adelaide. Brisbane still had 0.9 growth for the quarter, Adelaide 1.2. So, yeah, it's interesting that that is happening without having a high number of sales. It's happening with just sort of the same level of listings.
Yeah, and I've chatted to a buddy over on the West Coast who does what I do. Things have definitely slowed down for them. It was
Yeah.
really heady and crazy. It was very difficult to get a local advocate a
Mm.
couple of years ago. I look at, as you just touched on, Adelaide's monthly change is similar to Melbourne's. Yearly change, though, they've tightened by 5%, and that explains why Adelaide just keeps on trucking as well. It's one indicator.
Mm.
Canberra yearly is up 17.1%, yet Canberra's recorded a gain just this month as well, so that's encouraging. And
Yeah, so
Hobart's,
what's interesting there is I think a couple of things that play often when there's a change of government from
yeah,
Labor to the coalition, people do move out of Canberra because historically the number of public servants
is
does
reduced.
fall, does reduce.
Yeah.
So people are potentially getting out ahead of time if they're following the sport, the betting markets on
Yeah,
who's likely to win the election. So that's quite interesting. And if we do look over the quarter, Canberra, according to CoreLogic's, prices have gone backwards by 0.8%. So there's often that plays out when you move from a Labor to a Liberal government. It's quite cyclical when there's a change of power in
yeah.
Canberra
Are you calling
federally.
it, Dave?
I'm not calling it, but maybe some of the locals are. So,
You wonder, don't you?
yeah, jump of 17% in
Yeah.
listings.
Now,
Yeah.
Darwin's the big surprise. Yearly change is down almost 27%. And Darwin isn't demonstrating that they've got a market shortage at all. In fact, it looks like they've had their demand just drop off a cliff.
Mm. Yeah,
Um,
it's a really fickle market,
it
Darwin,
is
I think.
fickle, yeah.
Oh, you're going to do an episode on, we're going to analyze Darwin,
It's a
see if
tough
we,
one to analyze. That's why I asked for an extension.
what's that? Yeah, what's that saying? It's an enigma wrapped up in a riddle.
Pretty much, I mean, it's a beautiful, beautiful city. There's so much
Yeah.
to like about Darwin, and there's some, interesting economic things for us to chat about. But its property
Mm.
market, I just haven't got a gauge on it, and I don't know many who do. It's a really tough market,
Yeah.
tough to
Oh, look, I
predict.
think it's pretty hard when, it's below its peak of over 10 years ago.
Yeah.
And yeah, so it's pretty hard, I think, to be able to get a read on it.
Mm. Now, Hobart, 8.4% up for the year. And Hobart's such an interesting little city. And I know that it's on a lot of people's lists to eventually move down there. We've got a lot of retirees that talk and dream about a life down in Tasmania. So you know, it too is a difficult one because it's so seasonal and
Mm.
economic conditions and certainly employment conditions can make a big difference. Now,
Yeah, yeah,
nationally, we're looking at 4.1% up for the last 12 months. And the monthly change, again, it's really hard to take that too seriously when you're coming out of January.
yeah,
Um,
yeah.
but I think old listings is the one that tells a good story. Because
Yeah, look, old listings probably tells us a bit of a history lesson, I think, in terms of what's happened with those markets over the previous 12 months.
yeah. Well, you can
Because, yeah,
see anything that's greater than 180 days is technically an old listing. And we've got three capital cities here that have a really strong negative shift in old listings, which means old stuff's being picked up and purchased.
yeah, yeah,
And it's Brisbane, Perth, Adelaide.
yeah,
Over the course of the year, that absolutely makes sense. It's consistent with what we've been seeing
yeah.
in the data
High
because they've
demand, yeah.
yeah, super high
Um,
demand. People just desperately trying to get their hands on stock. And
yeah,
if stuff's floating around on the market for 180 days, you've got a vendor there that's either disengaged or refuses to drop their price or won't meet the market. Well, all of a sudden, if the market catches up, they start to look attractive, and that's what's happened.
yeah. Whereas if you look at the weaker markets, they've got a much higher proportion of properties that have been sitting there for over 180 days. Now, the
Mm,
highest point there is Hobart with
yes.
47.5% increase in properties that have been sitting there for 180 days. Then Canberra at 31.7%, Sydney at 21%, and Melbourne at 12.4%. So there's a significant correlation between what's happened in price growth in the capital cities over the previous 12 to 24 months versus which cities have had their 180 day plus old properties hoovered up
Mm,
or ignored.
yeah, absolutely. Now, the next chart is the scary one. And we don't always talk about distress listings, but the data here is a bit interesting. It shows that Victoria is the state that's had the highest increase in distressed listings and, leading the pack at 18.2. Tasmania is just behind with 14.7, followed by South Australia, a bit surprising at 10.2, then ACT at 8.7, and then all of the other states and territories are showing a decrease in the number of distressed listings. So the question is,
over the
what's
last 12 months.
that's right. Yeah, what's been impacting Victoria? Well, we've had a few more taxes than the other states, and we've also had, sentiment that hasn't been great, and a distressed listing. It would
And
be
more builders
interesting.
fall over,
We
more,
have,
yeah,
yeah,
more businesses have failed, I think, in Melbourne or Victoria than in any other state in the last 12
yeah.
months.
And so this really illustrates that, and is definitely one to watch if we think that we're in recovery. We need to see where this sits in the next 6 months.
Yeah. And look, I think it is still worth noting these numbers are really small relative to the total number of listings in any of the cities. And
Yes.
and actually, if we look at just the gross numbers, even though Queensland it has less properties and people than Victoria and New South Wales, just gross numbers, and this has always been the case for Queensland, hasn't it?
It
It has
has.
the most distressed listings. Um, and New South Wales has more distressed listings than Victoria. It's just Victoria's have bumped up by the most in the last 12 months.
Yeah, and to give our listeners a bit of insight into the magnitude that we're talking about less than 1,400 listings in one whole month being distressed. So while that's, nearly 1,400 households that are hurting, it's it's not a large percentage when we look across all of the data.
Yeah. And that's Queensland, New South Wales, 1,244, Victoria, 1,105.
Yeah.
Okay. Consumer sentiment. There's been a bit of movement again in consumer sentiment. So
Yeah.
what do you want to share here, Cate?
None of them were like massive monthly changes. I was a bit
Hmm.
interested in seeing what the interest rate cut would do to this sentiment. And if I look at the biggest change for the month, it was actually time to buy a major household item, which is a bit of a surprise because that's toys. But then time to buy a dwelling, that ticked up by 4.3%. So our time to buy a dwelling index is now at 91.6, which if you consider 100% is the zero marker, the neutral marker, that means that while we've had an increase in sentiment about now being the time to buy a dwelling, the majority still think that it's not quite time yet.
Yeah, and so we'll put a bit of perspective around that though. It has moved up from 77.8 12 months ago. So that's an increase in sentiment that it's getting closer to be a good time to buy a dwelling. It's
Mm,
increased by 17.8% over the last 12 months. And it was as low as 65.7 2 years ago. But
yeah.
what digging a little bit deeper into the state by state numbers, Victoria's actually had sentiment surge and
Right.
it's jumped up to be above 100. So Victorians actually, the majority, more Victorians think it's a good time to buy a dwelling now than
Yep.
not. It's gone up to 106 and jumped by 15.3%. So to contrast that with Western Australia, it's dropped down to 89.4.
Wow. This chart is telling and it's very valuable. And not that we want to track what we're about to do in terms of property decisions by a consumer sentiment chart, but it's one of the leading indicators that can give us some insight, isn't it?
Yeah, it is. I think it can, like, if you are trying to watch and pick up when a market's about to turn, it's certainly something that can give you some deep insights. There's obviously the gross numbers at the top level, but then if you get into the states, you get a better understanding of what people in those states are thinking.
Yeah.
Just in terms of house price expectations index, that is still quite high at 146.5. So people are still thinking overall that prices are likely to keep rising. Its historical average has been 128.
Yes.
So yeah, and it's bounced 10% from a low in January, up at 146.5.
And Dave, just to dive into that a little deeper, because you've got a better set of charts than me, what does Victoria say for house price expectations?
Yeah, good question. I don't actually, I just have I assume they're Anne-Marie just dives in and gives me some of their
Let's scrap
top
that bitch,
points.
Amy.
So I
Cool.
don't actually have other charts, but I think they just provide a few commentaries and stuff
Yes.
that I get Anne-Marie to dive in for. So I don't know. Sorry.
No, all
Just make
good.
sure. No, it's not in there. Um,
Now,
yeah.
interest rate expectations index, that's dropped to 88.2. So that's suggesting that we're even more confident that there won't be an increase in the interest rate. Is that your read of that, Dave?
Yeah, that's my read of that. Yeah. Yeah.
Yeah, so we're even more optimistic than we were last month. So now that we've had that cut, we're expecting that there might be more.
Exactly. Yeah. And I think that feeds into the improved in time to buy a dwelling index numbers and also why house price expectations bumped up a little bit. So
Mm,
if we move into the lending indicator numbers,
yeah.
what have we noticed in that space? You've highlighted some of the numbers that have changed over the last year.
Yeah, I've been a little bit surprised by this one. So we've got a quarterly change and then we've got the annual change. Total loan commitments annually are up 7.2, but over the quarter, they're down 0.4%. So close to static, but
Yeah.
slightly coming off. Do I mark that down to Christmas time? Because this data that we're looking at, the most recent data, only takes us to the end of the year. We always have a 3-month lag with the ABS stuff.
Mm.
Owner rocks were up 2.2 for the quarter or 4 for the year. Investors are interesting. So they were down 4.5% for the quarter, but up 13.2% for the year. I personally put that down to just Christmas pressure.
Mm.
Investors are less likely to make decisions as you get closer to Christmas. They kind of come
Yeah.
out of the blocks in January, and that's when they think about doing something with their money.
I think these numbers might be around loan applications or approvals versus, and so that certainly is a time people get to December and go, okay, I'm not going to put in a loan application
Yeah.
now. It's time to get ready for Christmas and make sure we've got the Christmas tree sorted and all the presents
Mm,
purchased and
that's it.
ordered our
Sort out the
ham.
credit card.
Yeah. So that might just be a seasonal adjustment.
Yeah. I threw in this next chart because I was really interested by it. This was personal loan commitments, so non-secured stuff. And it shows that we've got vehicles for sure, like people are really enjoying buying cars. And then we've also had an uptick in what we call other. That can be, elective surgery, that can be holidays, but there's been an increase. It's vehicles where we've
Mm.
seen the sharpest increase, and the cost of cars has gone up. So, that could potentially be highlighting just the broader increased cost of vehicles, or it could be showing that more people are making new purchase decisions now.
Well, do you know what? Yeah, there's some big jumps, aren't they? That's
Yeah.
over 12 months, whereas a quarter's pretty low. So I think that is people feeling the pinch and having to go to, these sort of personal loans and that type of loan to
Mm,
access money because they don't have, particularly probably maybe some equity in their home that they might have historically used to
yeah.
fund some of these purchases. And I have got, so the other includes personal investment, travel and holidays, other vehicles that are different to road vehicles, yeah, and
Yeah.
household goods.
Yeah.
Mm,
Yeah. It's interesting. I didn't think we'd see personal credit ticking up, but it's a sign of the times. And
yeah.
it's also a sign of confidence. People don't like
Mm,
taking on debt unless they're confident they can pay it back.
yeah. So if we look at the 3-year bond yield, which is the average rate that the bond markets expect interest rates to be sitting at on average over the next 3 years,
Mm.
currently the RBA rate's at 4.1%. What can you tell us about what the 3-year bond yield is saying?
Yeah, it's sitting just shy of 3.8%. So what that says is if things remain stable, which is my biggest disclaimer, we can anticipate that our cash rate will settle down, or that at least the markets are telling us long term that our cash rate should be hitting equilibrium at around that 3.8. And this hasn't really changed much over the last 6 months that we've been keeping an eye on this.
Yeah, yeah. So that is saying, look, on average over the next 3 years, we think them it's 30 basis points below
Mm,
where so it's basically one
one
rate
and a bit
reduction.
cuts.
Yeah,
Yeah.
yeah.
I think that's
Um,
possibly where well, who knows? Every
who
time I
knows? I
think
mean,
we
with
can,
yeah,
yeah, we've got
we're
a bit
talking
going on
well,
overseas,
yeah,
haven't
right.
we?
Increasing tariffs on everything that comes in from
Yeah,
every other country to the US, and then if other countries retaliate, should
yeah,
the laws of economics tell us push up prices, which then increases inflation, which
mm,
then forces interest rates to go higher to try and bring inflation back down, that's a big concern for a lot of economists.
yeah.
So that's what you're sort of alluding to there, isn't it? That
It is,
potential
yes.
instability. Yeah.
We've got geopolitical instability, not just relating to economic
Yeah.
interests as well. It's
Yeah.
a different world right now, and
And look,
unpredictable as
the share market is usually looking months ahead and the
mm,
earliest to react. And the US and Australian share markets and others have fallen by up to or pushing towards 10% in since around President Trump came in. So there's a bit more mumblings about the potential for a recession in the US because even Donald Trump is saying that there's likely to be some short-term pain. And if
yeah,
you look at some of the sentiment in the US, it's turning somewhat negative around expectations for the economy and different things. So
yeah,
yeah, there's and that's obviously just touching the surface of some of you mentioned geopolitics of some of what's happening around the
yeah,
world, which then does definitely flow back to Australia
yeah.
and our little nation. um, so if we just look at the employment numbers that were released on the 20th of February, nothing to see here really.
Not a lot. They haven't, you've got slight changes. You've got an increase in the employed people count and also in the unemployed people count. But really, we're talking about very micro shifts. It's been surprisingly stable.
Yeah, it has. Through all the rate rises, the biggest risk, one of the biggest risks anyway, is that
Yeah,
unemployment increases. And, the RBA was talking about trying to thread the needle to keep
mm,
unemployment low and still bring
yeah.
inflation down. A lot of economists thought that may not be achievable, but so
Well,
far it
so far
has.
so good.
Yeah.
Yeah, I would have thought that that's a really difficult, almost impossible task, but
Mm.
I'm not running the RBA.
So we then come to we just about finished this episode, but down to the wage price index, which was released on the 19th of February. So
Yeah, so it's
that was one,
relatively recent.
yeah. It's one of the concerns when inflation is high that it's called a wage price spiral. The more wages continue to increase, then there's more spending. It sort of reinforces that increase in inflation, which reduces people's cost of living, makes everything obviously more expensive at a faster rate. So there's a real, but then, you have collective bargaining agreements, you have big groups pushing for collective wage rises at the levels of inflation, and a lot of that happened. And so we saw wages increase significantly in terms of their average growth. They got down to as low as about below 1.5% around
Mm.
when COVID was hitting, and it pushed up into above 4%. But what are we seeing now, Cate?
Well, if we break down the industries, we're seeing healthcare, social assistance, manufacturing, and construction leading the pack, and they're particularly strong. What's interesting about this chart is once upon a time, electricity, gas, and rental and real estate services were up there, and they're right down the bottom now. So we've really seen a shift. The key stats suggest the seasonally adjusted wage price index rose 0.7% this quarter. Over the 12 months to December quarter, the wage price index rose 3.2%. So all of that's almost within target, isn't it?
Yeah, yeah. The quarter at point 0.7 is back. It's
Yeah, it's tame.
2.8%.
That's where
So
they
it's
want.
it's 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 reasonably tame. They'd like wages to be growing a bit above inflation. So
Mm,
people's standard of living is increasing, their salaries are going up faster than inflation. But it
yes.
certainly hasn't taken off, which was one of the concerns, and it has retracted once it got above that 4% marker.
Yeah. So we've seen that steadily come down, and to your point, it's almost where the RBA would want to see it.
Yeah.
So again, that's been comforting.
Mm. Okay, and to our last set of numbers, we had the quarterly release of GDP numbers for the last quarter through 2024. So that came out on the 5th of March.
Yes.
Unfortunately, with such a big set of numbers, there is a little bit of lag, but that's just where our ABS is at producing this data at this point in time. But there was some pretty positive news in the GDP numbers.
Yeah, there were. So throughout over the year, GDP is at 1.3. Um, from December to December, which is pretty good. And if we go down to industry and look at the seasonally adjusted figures, agriculture, forestry, and fishing, that was up there last time. And I remember you and Mike and I scratching our heads saying, I wonder what's encapsulated in all of that. Electricity, gas, water, and waste is showing its second highest in the list, sharing that spot with transport, postal, and warehousing. And again, what's interesting is rental and real estate services. It's almost it's close to zero. So that's really pulled back.
Yeah, and I think one of the second line, we have had a per capita recession going on, which
Yeah.
means yeah, we'd actually been in negative growth per capita, but because of our overseas migration, we haven't had a technical recession, and that had been for over a year, and we hadn't really ever had that occur. Well, hadn't that hasn't occurred for a long, long time.
Mm.
So actually, in the last quarter, we did get per capita GDP growth. It was only 0.1%, but it wasn't in negative territory for the first time in over a year. So,
Reprieve, isn't it?
mm,
Yeah, interesting. So all in all, household consumption grew 0.4% for the quarter. Government spending continues to support demand, and that increased 0.7%.
yeah, yeah. So we really need that private sector growth to get up there and keep bringing the inflation numbers down. So, well, that's probably it for February, Kate. We've
Right on
managed to
time as
get
well. We've
right
done
on
this
time,
well.
perfect. Managed to get through it without Mike,
Yeah.
who'll be yeah, sweating it up over in Thailand, churning out the
Enjoying some great
case.
curries.
Yeah, enjoying some curries and I'm sure a nice cold beer at the end
Yeah.
of each day. And he's having a well-deserved holiday off the back of that. So,
Yeah.
um, yeah, until next week's episode,
Yeah.
we'll
I look forward to seeing you this time next week, Dave.
see you again soon.
See you soon.
Bye.